Hello and welcome to Bondcast, a podcast series where we discuss our views on the latest themes and events shaping rates markets. I'm Imogen Bachra, European rate strategist, and I'm joined today by our global market specialists, Giles Gale and Jan Nevruzi. Before getting into today's discussion, I'd just like to remind you all to hit the like button and don't forget to subscribe so you can get the latest episodes as soon as they're available. A very volatile week in markets this week. The Russia-Ukraine situation definitely escalated, I guess, over the weekend and into the beginning of this week. We've had like I said, a lot of volatility in markets. We're recording this on Wednesday. So yesterday on Tuesday, markets basically did a full round trip in terms of their risk on, risk off. What do you kind of attribute that to, Giles? You know, how much more risk off do you think we can see, or are markets being too complacent in terms of what's priced in now? What's your take on that?
I mean, I think markets are naturally confused, right? Because it's something that can escalate an awful lot further, and I don't think that this is necessarily the right place to get into this in much detail. But I think that my personal view is that I think that a significant further escalation is actually quite likely, and what would that mean? Well, the assumption is that it would be hit to business confidence, probably. It may be a good reason for people to take a good hard look at stock valuations. That seems to have already happened. I would say that most people would probably reflect that stocks might actually still be a little bit overvalued, maybe quite a lot overvalued, and so it might be a reason to for an ongoing correction there. For rates, it's tough, right? Because it's in principle it could be an inflationary shock, and so that should mean rates higher. But maybe it's a temporary one, and therefore it's something that central banks should essentially ignore. And then there's also the question of what is your quality asset towards which you fly in this kind of environment. And bunds obviously are often high at towards the top of that menu. Treasuries and gilts are also, but you've got forces in both directions. My personal view is that this will end up driving rates higher and not lower, but let's see.
I guess then, thinking about the impact that this could have on both growth and inflation, do you think that these, I guess, escalations of geopolitical tensions is a reason for the ECB to be more cautious about their kind of projected pace of tightening at the March meeting?
Yeah, I think that they will take it that way. When it comes to big sources of uncertainty like this, then I think clearly you have to worry. You have to ask, okay, so what is their risk adjusted approach to that risk? Okay, here I think that the basic assumption is that it is an inflationary risk in the short term, but above all, it's a potential longer-term disinflationary risk. Okay, and that certainly seems to be the way that the ECB is set up. Clearly, they have been shifting more hawkish, but I think that in these sorts of circumstances, they will flip back to that kind of mindset. So I think that caution in this case will mean that they will tend to be less aggressive in their hawkish shift than were this not in the background. Simple as that. But just to remind people, we do think that they will accelerate their timeline for quantitative tightening, lack of a better term, the end of quantitative easing, which should now, we think, end in September, and that will then set up or validate expectations for a rate hike in December.
Just, I guess, quickly switching over to the US and we will come back to Europe, but while we're on the subject, same question to you then, Jan. Do you think that this changes how the Fed are thinking about their tightening? Because we know that they're obviously reacting to a different point in the cycle, and they're kind of further down this tightening path than the ECB are. So does that change how you think they might react in March or beyond?
It's going to be on their dashboard, but it's not going to be the main risk factor, I don't think. I mean, whatever's for Europe, I would say the Fed is one even further step more distance than what the ECB situation is in. The Fed's probably going to focus on the energy impact, see how that spills over into inflation. So it might even push them to be a little bit more hawkish, and that's exactly what markets priced in. We kind of got to the point where people don't think that it will have direct impacts, at least from like a growth side or involvement side for the US, and more so possibly some like increased energy prices, which might force the Fed's hand even further. So I think if anything, it makes things a little bit, it just pulls back the timeline a little bit earlier.
Sticking with inflation there then, Giles, because we've talked a lot about what could be the potential impact of these tensions and particularly on natural gas prices and what that means for euro area inflation. We had Giovanni on the pod last week who talked about that kind of in detail. So if anyone's interested in that, please do go back and listen to last week's episode. But we've kind of seen the almost opposite market reaction. We've seen five-year inflation fall. Does that really make sense to you?
So no, I think that five-year break-evens, to take that as a benchmark, falling in these circumstances doesn't make a lot of sense. I think that whether this particular risk actually materializes or not, I think that we are quite clearly transitioning towards a more inflationary world from the European perspective, as well as other advanced economies, and the need to include in the transitions that we all know about an emphasis around energy security is likely to just add an extra layer of sort of inflation to the next many years. And so I think that this is something which helps rather than hinders our rebalancing of inflation expectations around about the inflation target. So five-year break-evens at 1.75%, that seems pretty low. And the fact that they're falling into all of this doesn't make a lot of sense. Compare and contrast what's happening in the UK, for example.
So, well, you mentioned the UK, so let's go there. Aside from geopolitical tensions this week, there's been a lot of central bank speak, particularly from the Bank of England. I'm getting bored of hearing myself on this podcast ask the same question to Jan about it being a 25 basis point or a 55 basis point in the US. So I'm going to switch it up this week because it's not just the US where this kind of debate is taking place. Also in the UK, we've got markets kind of oscillating between expecting, pricing in more or less chance of a 50 basis point hike at the March meeting from the Bank of England. How likely do you think that really is?
So reasonably unlikely, and actually the central bank speakers that we've had just in the last couple of days, in particular Ramsden yesterday and Bailey today, both appeared to suggest that 50 basis point hikes are maybe a little less likely than markets are currently contemplating. Now, just to give you an idea, over the next 3 meetings, there's about 90 basis points priced in, which, if you consider that 3 meetings at 25 basis points is 75, then the extra 15 that adds up to essentially a 60-70 percent probability that one of those meetings will actually be a 50 basis point move, and that seems to us to be too high.
What about inflation expectations in the UK though? Because I guess unlike what we've just talked about in the euro area and other kind of global economies, we're seeing high market-based inflation expectations in the UK. Does that make sense to you?
Well, high expectations I could completely understand, but what we actually see is very, very high expectations, and that's kind of the nuance here. I mean, the markets are really not contemplating CPI coming back down towards anything like target for decades. I mean, if you look even 10 years out, when the RPI becomes the CPI because of the RPI CPI reform, we're still at about sort of 3.6%, and the idea that we will miss on such a extraordinarily sustained basis by such a wide margin the inflation target, I think, is probably a little bit of a stretch, even if our starting point is that inflation is high and it's going to be in the system for longer than maybe many professional economists and so on expect. The markets are already there and way past it.
Silly markets. Okay, switching over to the US then, Jan. Like I said, I'm bored of hearing myself ask a question about 25 or 50 basis points. So I'm going to switch it up slightly this week, because another, I guess, topic that we've spoken a lot about on this podcast and is driving a lot of our kind of trade views in the US is just this idea that markets still aren't pricing in a kind of high enough terminal rate in the US. So even though they might have kind of front-loaded expectations almost versus what we have, in the immediacy for the policy outlook in the next few weeks, actually over the longer term, we still have a higher terminal rate than markets are expecting. Why is that? Why aren't they this kind of view of the terminal rate rising? And is any of that because markets are ascribing a kind of higher tightening value, I suppose, to quantitative tightening that implies fewer rate hikes, perhaps?
I think QT is probably quantitative tightening is probably part of the whole logic behind it. But also, I think from our feedback and what we heard from people with opposing views is that generally people assume that the Fed is either going to be able to either control inflation once they deliver the rate hikes this year. So if you look at a little bit forward inflation expectations, they're not really all that high past the 2-year point. So it's just the assumption is the Fed will be able to normalize that, and they wouldn't be able to go further than like a couple of hikes only, like no more than close to 2%. And the other thing is people just don't really expect that anything has changed materially from the last cycle. So if they had to stop at like close to 2.5 last time, what would force them to go even further this time? Of course, we disagree with that, and that's what forms our flattener and short kind of like 3-year points. But I think that has been the sort of like the main view, that nothing has changed this time. It's all very similar to before. There's going to be this kind of drag and growth. There's going to be that overhang. And I mean, I guess this is a conversation for other parts and other notes we've written that we disagree with. And QT is also part of the package. I don't really like doing direct comparisons of how much QT impacts, what's the transfer ratio between 100 billion of quantitative tightening or quantitative easing to rate hikes. I don't think a real answer exists. I mean, there is research from 2015. And if you look at it, I believe they said the 2015 level of QE that they had delivered was something about 400 basis points in rate cuts that they avoided because of zero lower bound. That is not going to be as much anymore, because since the system has been saturated with so many reserves, and after such a prolonged period of buying, the elasticity has to be lower. So each dollar bought or each dollar returned back to the market should have less impact. So another, shadow rate is another measure of gauging, and these are all sort of consistent that about the entire flow of QE that we got this time corresponded to about close to 1 percentage point in additional cuts that the Fed could have delivered. Again, I'm not so sure that's exactly how it works, because just as a kind of reminder, I mean, the last 1.5 trillion or so of quantitative easing has been flushed right back to the Fed through the RRP facility. So it pretty much did no easing except perhaps stabilize in a relationship between on the run, off the run bonds and so on. So I don't really have an answer to how much QT will replace in rate hikes. I'm willing to say they will use that as an excuse perhaps to either deliver or not deliver. But I'm of the view that the Fed still has a lot to discover about how QE or quantitative or just balance sheet adjustments impacts the market and the economy. So they're probably not going to be very aggressive around that.
So we're only a couple of weeks away now from all the kind of major central bank meetings in March, which means that we will begin to enter blackout period from kind of next week onwards. Obviously, next week we kind of have the last chance to hear from Powell before the blackout period. Are we expecting to learn anything kind of new at this testimony, or do you think that it will just be repeating what we've heard the last few weeks, I guess repeating somewhat the message from the minutes, and then more of a surprise potentially at the meeting in March?
Following this month's inflation number, and after that St. Louis's Bullard coming out very aggressively with the need for intermediate hikes and 50 basis point hikes and perhaps 100 basis points in the bag by July, the market has been kind of saturated with a lot of FOMC officials either and mostly leaning towards the need for a 25 basis point, let's look at the data, hike normally and kind of kick it off, versus 50 basis point like Bullard. But then so market is reacting a little bit less to each marginal commentary at this point. However, Powell is going to be different. He's going to, he has the privilege of being the chair, and also has the privilege of being perhaps the last speaker as the Fed enters a blackout period, which will be on March 5th, I believe, next Friday. He's going to set the stage, and it's really, really fluid right now. We have to see how things with Ukraine develop. But I think he would probably affirm what market is pricing right now, and it's not over 50% for a 50 basis point hike. So I think he'll go out there. He said they're about to start normalizing policy, but he's not going to stress anything about the need for oversized moves, the need to roil markets, or just kind of the need to go very aggressively at the beginning. I think he will emphasize that the Fed should start raising interest rates, start normalizing balance sheet much faster than last time. This is not new information, but I just believe he's going to reiterate what we've already heard from him. Not so much the more hawkish side, but more so like the central part of the both camps.
Yeah, the more, I guess, balanced kind of data-driven approach than either camp. Okay, great. Well, I think we'll wrap it up there for today. Thank you both for joining me. Just a reminder to our listeners that if they like today's episode, please don't forget to hit the like button, click subscribe so you can get the latest episode as soon as they're available. Thanks. See you next week.